Hi, I'm Kerry Craig, Global Market Strategist, and in this video I'll be sharing our views on asset allocation using the Guide to Markets for Australia. Historical evidence shows that geopolitical conflict and the impact on the overall investment landscape is usually relatively short-lived. In this instance, however, the impact from energy and commodity prices on consumption and business investment, as well as other consumer behaviour, could be more meaningful. Investors may opt for a more defensive approach in the near term, using government bonds or other defensive strategies to manage that portfolio volatility. Concerns over commodity supply create a tactical allocation towards commodity producers and exporters. However, we anticipate a reduced pace of economic growth rather than a recession, maintaining our preference for risk-on assets such as equities and corporate credit, even if to a lesser degree, especially given the sharp move down in valuations since the start of the year. Historically, risk assets continue to generate returns once the US Federal Reserve hiking cycle gets underway. We believe the overall corporate earnings remain robust, supporting both credit and equity markets. In the US, the strength of the labour market should help consumers overcome the rising cost of living and increasing in wages. In Asia, economic reopening, as well as the pandemic coming under control, should also help. Europe will likely take longer to return to its prior economic growth path given the longer-term changes required to diversify its energy sources. The rise in government bond yields should become more moderate, making duration risk less of an immediate concern. This gives investors more flexibility to generate income in bond markets, including corporate high-yield debt and emerging market fixed income. While central banks are normalizing monetary policy, cash returns will trail inflation across most economies. For positive real yields, we look towards high-yield debt, developed market equities, and thinking about alternative assets for persistent real income. Investors should take stock of the asset correlations in their portfolios given the volatility experienced in the first quarter. The sell-off in both government bonds and equities in times of stress has come back. However, as geopolitical tensions stabilise, investor risk appetite should improve, as will a flow towards risk assets. Our base case remains for steady, if not lower growth this year, and that continued tilt towards stocks over bonds, value over growth, and credit over government bonds. Thanks for watching.